There's plenty of money from the sovereign wealth funds coming in from the Middle East and other places to fund these things. But isn't it interesting that as we see this little bit of a pullback, now the big private equity firms are willing to share direct access to private equity with individual investors where that hasn't been the case. I used to tell people in class, I still tell people in class, it's like if you come to me and ask me to invest in your company, the answer is absolutely not. Because that means you've already talked to 1,000 people who are a lot smarter than me who've said no. I'm so excited for what's happening. This is really a remarkable period. This is the greatest period to be an entrepreneur or have an idea in the history of the universe. It's amazing. But let's talk about why.
Hello and welcome to Tuesdays with Morrisey, where we share insights from great thinkers. Today I'm excited to be joined by Dr. Ken Wiles, Clinical Professor of Finance and Executive Director of the Private Equity Center at the McCombs School of Business at University of Texas at Austin. We're continuing our mini-series on the alternative asset market. Dr. Ken, thanks for coming on the show.
It's great to be here. Thank you so much for having me.
I'm excited to have a conversation about the current state of private equity and also what you're seeing in the educational environments with all the shifts around the education setting with AI, career shifts, cultural shifts. I want to start with a stat related to private equity. I saw a viral tweet that said there are 19,000 private equity firms in the US and there are 14,000 McDonald's in the US. So given this prevalence and increasingly more mainstream nature of private equity, I want to lay the foundation for the conversation. If you could just speak a little bit to how you define private equity, its origins, and how we got here today where there's more private equity firms than McDonald's.
So you're really asking, where is the beef?
Exactly.
So it's interesting because private equity, and that's going to sound trite, but private equity is everything that's not public equity. So if we're going to take a company public, we have to register it with the SEC, and we have to produce all this information so that the average knowledgeable person could make an investment decision. But private equity and private capital, more broadly defined, which would include private equity, venture capital, infrastructure funds, private credit, everything, that's all sold to sophisticated individuals or institutions and not to the public. So it really is an interesting market because it really didn't start developing until the early 1980s. And it's kind of something that's important because you'll listen to people on different types of broadcasts and they'll always say, well, it's different this time. And it never is. This time it's different. And if we go back to the 1970s, think about the markets. We had no information available, really. No internet, no cell phones. We didn't have Bloomberg. We didn't have all the online databases. So you had these big companies that would almost create like their own private portfolios. Companies like Beatrice would own everything from Avis Rent-A-Car to Harman Kardon speakers. And their idea was we'll create kind of a public portfolio because we didn't even have mutual funds. Well, that's inefficient, but it may have provided a diversified portfolio for investors. In 1981, the 10-year Treasury was 16.5%. About 3 years ago, it was 0.5%. For a 41-year period, we had declining interest rates. That's the first thing. Second thing is we had the development of the junk bond or private, the debt markets, so that private equity firms started to form. They borrowed money and they went and bought some of these big, inefficiently run companies and started to break them apart. So the 80s was the dawn of the LBO. Probably a few of them were a little bit over-levered and had some trouble, and we got some great movies out of it. So, like Wall Street and Barbarians of the Gate. So there was that. But if you think about it, if interest rates continue to decline, well, that means that discount rates keep dropping. So what's happened over about a 40-year period is, in general, I could buy something for, let's say, 8 times cash flow and sell it later for 10 or 12. Okay, so the markets and discount rates helped me. And then the market of inefficiently run companies helped me. Okay, we had almost no venture capital markets back in the early 1980s. It was very hard to get a business up and going. The The costs were prohibitive. It was very difficult to compete against big companies because we didn't have the money, didn't have the capital to support it. Okay, so let's go up. We've had some little drops, like obviously 2000 when the NASDAQ kind of popped a little bit. We had 2007, 8, 9. There was this little recession. Of course, we had 2 weeks when COVID hit. But just in general, for more than 40 years, we had very attractive markets for people to go in and fund private companies. Okay, so real quickly, venture is different because we're starting and helping to back a company in a brand new market, something untested with people we don't know have worked together or whether they'll work together. We don't know if the technology will work. We don't know if anybody wants to pay for it, right? So we've got that, but we start with a little bit of money, we feed it in over time, and then those companies are either successful and we make a lot of money, or they're unsuccessful, and that often will happen quickly, and then we just go to the next company. Private equity is different. The historical focus for private equity was in a very important part of the market. If we have a company that's performing poorly, but there's a chance to recover it, there's a chance to restructure it, but we need some money to maybe bridge this restructuring gap and to make changes, to buy new equipment, to maybe expand products. If it's performing poorly, and historically, private equity targets have performed poorly for at least a couple of years, banks are not going to lend them money. The best case for a bank is I get paid back with some interest. If there's a probability of failure, I get no upside and I just stand to lose money. So who do we have give them money? It's private equity firms come in and buy the company, make the changes, and then hopefully are able to resell it. Over the past few years, though, that market's kind of changed a little bit, and we can talk about that, but that was the traditional path. And then we've splintered off into everything from energy funds to infrastructure funds and all sorts of other things that are privately capitalized.
Yeah, I mean, it's certainly changed a lot. You mentioned barbarians at the gate. That transaction, I think in a lot of people's minds, marked the beginning of private equity as we know it. But, even since, it seems like, it was kind of like an East Coast thing, it seemed like, for a long time. And then, now, I mean, I remember I graduated from college, in 2013. In the Midwest, not a lot of people were going into even banking or private equity. And now, as we'll talk about probably later in the educational environment, more people are trying to do it regardless of where they go to school. And then the other thing I'm seeing too, just in my work life, is, no one's doing that model anymore. So I think that's another big change. The model of like a private equity firm buying a bad company, cutting all the people and waving this magic wand to turn it around. Everyone is only working on growth stories. It's like, hey, like we want to buy good companies and grow faster together. Can you talk a little bit about kind of like those incremental shifts that kind of drove, what we're seeing today?
So that's a great point. So we go back to about 3 years ago when we said that 10-year treasury hit 52 basis points. Now, again, I still don't believe it. It was like, let me see, if I lend the government money, $1,000, they'll give me $50 a year and then my money back. That's when everybody refinanced their house and we blocked up the mortgage market. What's interesting is, and that's the inflection point. It was about 3 years ago. So from that point on, the Fed in March of 2022, and if you look at any graph of deal activity, fundraising, exits, whether it's private equity or venture capital, you'll see a substantial change. Fundraising dropped about 40% the next year. Deal flow dropped about 30% the next year. Everything changed then. And why? Well, once rates went up, and remember, the Fed targets the federal funds rate, this short-term rate, but it influences the longer-term rates. That was the start of the fastest increase in the federal funds rate in the history of the Federal Reserve. So we went from a target rate of about 25 basis points, 1/4%, to more than 5%. So 5 1/3. Okay, so that's a 21-fold increase. And then risk spreads will spread even more on top of that. So we had a dramatic increase in interest rates. So think about what that did to valuations. All of a sudden, interest rates spike, the value of companies drop, which means that sellers don't want to sell their business. It's like, hey, last year I was worth 100 million. Today I'm only worth 50. Yeah, sorry, but the question is, what are you going to be worth a year from now? And many people hoped that if they could just bridge this gap over the next 2, 3, 4 years, we're 3 years into it, 3.5, that maybe the Fed will start moderating, markets will improve, and then we'll start to see more deals occur, both on the sell side and then, of course, on the buy side. The issue is, and this is the number one factor in private markets right now, is liquidity. And there's an old expression, liquidity doesn't matter until it does. And then it's the only thing that matters, right? So to put it in a little perspective, here's the problem with liquidity right now. The old deal in private equity was, in essence, if I'm an investor and 2/3 of all of the money going into private equity funds come from public and private pension plans. So they rely on this money to help pay the people who are retiring. Okay, so the deal was, I give you 100 million, and sometime in the next 6, 7 years, you give me back 300 million. And then you raise another fund, I invest in your next fund, and we do it again. But there's a problem. If I can't sell companies, or if the sales are delayed, one, I don't get the money back to cover my obligations, and my returns drop significantly. I'll give you a quick, easy example. If I buy a company today for 100 million and I sell it next year for 200, my average return is 100%. If I sell it after 5 years, it's 15%. If I sell it after 10 years, same thing, buy for 100, sell for 200, it's 7%. So every year we go out, our returns are dropping. The average holding period has gone from about 4 years to over 6 years. So the returns are dropping. I'm not giving the capital back. And the other thing that's happened is that because interest rates have gone up, I can now invest, if I'm a big pension plan like the Teachers Retirement System or CalPERS out in California. I can invest in bonds and public equities and other securities that can give me a very nice return without even having to put money into more risky long-term private equity or venture. So liquidity is the problem. We're not giving the investors the money back. They're not willing to put as much money into the asset class. So a couple things are going to happen. One, returns are going to be much lower than expected. And a lot of these funds are going to have extreme difficulty raising another fund. Yep. So we're going to see a lot of venture capital and private equity firms be unable to continue.
Yeah, I mean, a couple of things there. I mean, I worked at an early stage tech startup that started in 2020, and we were actually fortunate to start in 2020 because we didn't start in an era where you could take as much money as you want. So we saw, many companies, series like fundraising stages away from us, have their valuation halved, and everyone's talking about, oh well, maybe to start a big company, venture-backed company, you actually have to have fundamentals. So it seemed like, there was a window where it seemed like, oh wow, like this is gonna be like a back to basics thing, and it only lasted for a moment, and it seems like now it's gotten crazy again. Not even just in venture, you're seeing so many unicorn valuations. Private equity, obviously, despite all the stuff that you mentioned in your article and recently in this conversation, the way you put it, the math ain't mathing anymore in your article. I mean, the thing I'm seeing too is like, all right, like the companies aren't worth as much as they used to be. It's also more competitive than ever. So the valuations that we're seeing at my firm are, still high. So like, the days of that you can get, the information's more out there too. More people are reaching out to these companies. The buyers are way more educated. The idea that you're going to get companies at a bargain of market value are kind of gone. I saw the same thing in a recent stat. It was talking about the shift in family office allocation from private equity to even public markets. So when we think about the concept of the math ain't mathing, we talk about there are going to be less firms. Maybe that McDonald's ratio will go back the way it should be. But could you speak a little bit to we've seen a couple things, right? Like, we've seen a stock market crash before. We've seen a housing market crash before. Like, what does it look like when a private market crashes or corrects? And then if you could, speak to just kind of the relationship between between the private market and the public markets, especially as we're in new territory. In our last episode, we met with the folks at AB Private Credit, and they talked about, private credit makes up, it used to be 25%, and now it's 75% of, capital providing in the middle market. So I'm curious, like, what's really at stake here, and how does it relate to kind of the public markets and the broader economy as well?
This is an interesting question, and I'm excited to see what happens.
Yeah.
So one thing that happened, so go in order in terms of like market resets or hard landings and things like that. A few years ago, they were talking about, well, when are we going to have, what kind of landing are we going to have with the market, right? Are we going to have a soft landing, hard landing, no landing? There was a V landing. I don't know. There were all sorts of landings. I don't know. Usually if I'm flying, landings are good. But this is something where the market missed it. We did have a hard landing. It was just in private capital. And with private capital, we don't see it every day, right? In the public stock market, we can see if a share of Microsoft drops from 525 to 450. And we immediately see it. We can trade on it. If we disagree, we can buy or sell. But in private markets, in PE funds, we may buy a company 3 years ago. That kind of sets the price unless we mark to market. So the value of the company is changing every day, just like any other company, but the pricing stays constant. So you'll hear these private wealth managers now that there's increased access potentially to private funds for individuals in their 401ks. Be very careful, because they're going to tell you that they're less volatile. That's absolutely not true. The pricing may be on the books for what they paid for it. And that may not change for years because there's no additional funding. There's no price change. The value of the company is changing every minute. And because they have less access to capital, because they're not public, they don't have public and private, all that, they're going to be a lot more volatile and a lot riskier. Okay. So there was a crash. We saw a crash in real estate. Right? You saw values of buildings in New York and all across the country dropping 40, 50%. Yeah, it's kind of modifying a little bit. People are supposed to get back to work. We'll see. But in terms of asset utilization, maybe we get back, maybe we don't. We built a lot of apartments. Values are coming down there. In private markets, we saw the crash. Again, it's the same thing. Venture capital sometimes they'll put money in, and let's say they put money in a year later, but they don't want to acknowledge that there's a drop in value. You may have the insiders, the people that have been making investments, get around a table and say, look, let's just do what's called an extend and pretend. We're going to put money in at the same value and just hope it gets better in a few years. So remember, there are a couple things we know. One, all private valuations are wrong and they're manipulated. So remember that I think there are, depending on your list, more than 1,200 unicorn companies. So companies that started off as startups and now have a value of over $1 billion. Yeah, based on what? A friend of mine and I did 2 papers. Keith Brown and I did 2 papers on unicorn companies. First one ever published in the academic literature, we think. In both samples that we did, a third of the companies had a value of exactly $1 billion.
Yeah.
That's not possible. So we're manipulating these values. So we'll see what happens. The point is we have had a market reset. When it does it in the private markets, we don't see it as much because the company owners and the lenders and others will try and renegotiate things out of court or out of the public out of public sight. So we can restructure a deal without making many public acknowledgments of it. So you'll see a lot of this happen quietly. Now, one other quick thing. When real estate pulled back, a lot of regional banks were very active in real estate lending as well as LBO lending, and big banks too, but there are a lot more regional sized banks, which are still good sized banks, right? So the regulators were looking at their loan portfolio and saying, these real estate loans are pretty risky. We're not excited about you extending into more private debt. I'm sorry, LBO lending.
Mm-hmm.
So up popped the private credit funds. This has been terrific. It's been great, because imagine if we didn't have private credit and the banks aren't able to either extend loans or modify loans, we would have hit a maturity wall where a lot of these loans would have come due this year. It would have been very, very bad. So with private credit, they've been able to provide lending facilities, lines of credit, senior term loans, term loan B, all these other things that can help finance these deals that have extended the maturity wall. So a lot of these loans now will mature in 28 and 29. That's so helpful, because to the extent values are down, this gives us a bit of time to work through restructuring or to do mergers and acquisitions, to maybe have the economy grow, to build the company back up. So it's taken a lot of the pressure off. But private credit's never been stress tested.
But it's interesting though. Like in my last episode, talked about like private credit has become so core to the private equity playbook and just like so integrated. Like, how do you say no? And I was pleased, the group I was talking to, they see 1,000 deals a year and they do 40, I think. So it's like, there are going to be groups. It's like, like any correction, it's like, remember I did an episode years ago on a previous show about, real estate markets and COVID with the SMU real estate professor. And he's like, look, Class A assets are still going to be Class A assets. So it's the same thing I'm thinking here is like the best firms are still going to be the best firms. And it's the ones who, chased, kind of like what we see in retail hype markets. It's the ones that are chasing that often end up getting burned. Speaking of, you mentioned retail access to private equity funds. I have some friends who like almost daily a link will get sent, like Robinhood announces an evergreen or retail strategy. KKR has one. Vista in town launched one, and it's all about this idea of private retail access to private markets. And what my friends and I always talk about is like, all right, like it's not because the wealthiest individuals and the biggest pension funds are tapped out from all the good returns. It seems to be a little bit of a money grab and a fees play. But I'm curious, if you're even deeper in the field than I am. So I'm curious on your take.
You always have to look at the incentives. And if you're not looking at the incentives, you need to look at the incentives. And so it strikes me as ironic timing that we have had outsized returns, say in private equity, 15 to 20% returns for, better part of 3 or 4 decades. And, ups and downs, but pretty good returns. The moment the Fed started increasing discount rates in 2022, and we have a liquidity problem where institutional investors who provide the vast majority of all private equity investments, as we said, pension plans, 2/3, but add sovereign wealth funds and others. There's plenty of money from the sovereign wealth funds coming in from the Middle East and other places to fund these things. But isn't it interesting that as we see this little bit of a pullback, now the big private equity firms are willing to share direct access to private equity with individual investors where that hasn't been the case. I used to tell people in class, I still tell people in class, it's like if you come to me and ask me to invest in your company, the answer is absolutely not. Because that means you've already talked to 1,000 people who are a lot smarter than me who've said no. And I've looked at some of these funds. Okay, I looked at one on one of these platforms, and no kidding, I would have gotten the wonderful opportunity to invest in loans to wealthy individuals where the collateral was collectible art. Yeah, I'm not getting Apollo's top fund here. We're not getting it. They're going to give it to their largest limited partners who continue to invest in the funds. I would be very wary, and people need to understand the challenges. There's very limited information. Remember, these are blind pools, which means I'm putting my money into something for like 10 years. I have no idea what they're going to invest in. I'm just hoping. It's based on the reputation of the firm, their track record, the structure, like something in a big fund I may have a little more confidence in, but we don't know what it is. We don't get much reporting. You don't get much visibility in the company. They're very illiquid. I can't just go in and buy and sell these things. So you got to be very thoughtful. I would highly recommend, if people are interested in private equity or credit investments, go through their pension plans, go through investors that have experience and knowledge in the industry, and there are ways you can get into it. I'd be wary of putting money in my retirement plan, no matter how many trillions of dollars are there, into private equity.
That's fair. I mean, one of the things I think I've seen and think about is like, I think, in some scenarios, like private equity is a great solution for a business. It doesn't seem to be the answer to every single scenario or industry. I mean, how do you think just about generally how private equity impacts, both competition and then opportunities for entrepreneurship as more and more things get, quote, private equitized?
I'm so excited for what's happening.
Yep.
This is really a remarkable period. This is the answer at the end is, this is the greatest period to be an entrepreneur or have an idea in the history of the universes, or at least the known universe. Maybe there have been multiple, and this is amazing. But let's talk about why. Go back 25 years ago. And I noticed you said you graduated in 2013. I
quite young. I would have been like 9 or 10 years old. So
thank you. It's very depressing for me. I have children. That's why I have gray hair. So let's think about 25 years ago. So I was the COO of a software company in Atlanta. We ultimately sold it to Oracle. And, I've worked at some investment banking firms. I took a couple of companies public, one with JP Morgan, one with Bear Stearns. I've run restructuring firms. I've done a lot between the period when I got my PhD at UT and then was on the faculty at North Carolina and then came back 10 years ago. But let's go back to 2020 and think about things a little bit. If I wanted to start a private company, let's say a startup, and I'm going to refer to enterprise software because it's something I know a little about. We were an enterprise software company. So what did we have to do? Well, we raised about $5 million so that we could get some office space, so we could hire some developers, so we could build our server stacks, and I punched down cables and all that stuff. Think about what happened shortly thereafterward. Instead of those kind of fixed costs, where this $5 million fundraising round provided us a barrier and probably gave us a couple of years run rate relative to anybody who had a similar idea, because they would have to go get fundraising and do all this other stuff. You don't have to do that now. Instead of raising 5 million, I may be able to accomplish, say 10 years ago, 5 years ago, I could accomplish the same thing with maybe 500,000, because I don't have to rent 20,000 square feet of office space trying to figure out how many people I'm going to hire. I just go rent stuff from WeFail. I'm sorry, WeWork. You scale up or down. I don't have to get a server. I can go to AWS and I scale it up or down. I don't have to hire a development team. We have developers around Austin here, groups and teams that'll come up and do the work for you. There's some traffic lights near campus where if you stay there too long, you get somebody knocking on your window and saying, "Hey, dude, you need some code?" So we've got all those things. So we converted fixed cost to variable cost. Software development became componentized. When Lyft and Uber pulled out of the Austin market about, it was like 8 years ago, because they got in an argument with city council. Ride Austin was up and delivering services within 30 days. Oh, okay. So we dramatically lowered the barrier to entry. Oh, okay. Now come to today. Now we've got AI that can get us to drafts of code. Now we still need a senior coder. We still need an architect. We need somebody that understands product market fit, that understands growth strategies, security protocols, all this other stuff. But now those things where we would have to hire a team of developers, instead of getting even outsourced to a team of 10, I might be able to get that done with 3 people over a weekend.
Yeah.
We're crushing the barriers to entry. If you have an idea, you can learn anything, you can develop software, you can prototype products, you can do things at speeds that have never even been considered before. This is remarkable. So let me just mention one other quick thing. And I think this is critical to understanding the growth of private equity and where in venture and where we may go now. If you think about it, why did private capital markets grow so fast? And why have we gone from, a few $1 billion? Like right now, private equity firms in the United States have about $1 trillion of capital that they can deploy. If they borrow half of the money to buy a company, that means that $1 trillion gives them $2 trillion of buying power. There's about $350 billion of cash sitting around for venture investments. Turn on the news almost any day and you see some of these big companies signing billion, $2 billion, $100 billion, $500 billion deals. These are big numbers.
Yeah.
So think about what happened. With operating barriers declining, like you were saying, companies are better. You can learn more from master classes online. You can do modeling exercises at Wall Street Prep.
Yep.
So the kid in Iowa can sort of learn how to become an investment banker, get the tools, where that wasn't the case 20 years ago. So as operating barriers decline and costs to entry decline, that means competition can arise much faster than it used to. You don't have a 2-year window. You might have 6 months, maybe a day. So if I'm thinking about going the traditional route, like it used to be, I'd raise 15, 20, $50 million, and then I have to go public because that's where the big pools of capital work to drive my growth. Okay, but that's a slow and uncertain process. It's 9 to 12 months. Typical underwriting costs are 15%, 10 to 15%. And if it's 9 to 12 months, I got to hope that in a year from now, the markets are in good shape so that I can actually go public. What if there's a pullback? What happens? I got to go raise capital. Now I'm distressed. I'm in trouble. Okay. So why do companies like to raise money in the private markets? Well, if I'm growing a company and I've got to get there first or second or third, be one of the top 3, right? In there, grab market share, grow this thing and try and get as big as I can and defensible. Then I want to raise capital and be secure in raising it. If I wait 12 months, I don't know that I'm going to get it. So one thing I could do is go to the private markets, negotiate a deal, and let's say I'm raising additional capital, I just could probably raise it over a weekend. I don't have to go public. As long as I have access to the capital, as long as the funds are big enough, they can basically replace what would have been an IPO. And now we see that. Their investment rounds $300, $400, $500 million. That's bigger than an IPO used to be. Okay, so for the companies, they can stay focused on operations. They don't have to release a lot of information to the public. They have a better chance of succeeding. Funds like it because now they're capturing that rapid growth that used to occur after an IPO. Now the funds can do it. So the funds love it. The companies like it. As long as the values are going up, everybody's happy. Now, because of declining prices and liquidity, now we're going to see fewer funds. The underlying operating conditions will still be there, but maybe there'll be slightly smaller funds, fewer funds, a few more companies going public earlier. But ultimately, private equity is not going away. Private capital is not going away because of these operating benefits, the ability to stay focused.
I like your example of how great it is to start a company, and you use the software lens. I'll use the alternative lens, like the smaller business, local business lens. My last company We worked with plumbers and HVAC guys. So I think three industries where I've seen private equity consolidation, where I think there's going to be a lot of white space kind of on more local levels. From my own personal experience, the trades, one. Two, also personal experience, CPA firms. There's a lot of other dynamics there too, with wealth management getting into more CPA services. And then three, dentistry, just from personal experiences. Like, you take the trades, you see, like one of the things we saw is, when a private equity firm buys a trades company, not all of them, there are some that are really, really good at preserving cultures, but you often see key man churn. And you also, when you're working with a lot of these firms, they're spending the most on marketing and they're the most expensive. They will oftentimes price match if they can get you on a recurring revenue service plan. But, if it were me, like, I want to find a guy that can get it done, the HVAC repair, the plumbing fix. So my sense is that there are going to be opportunities to start smaller home services companies, potentially benefiting from some of the things you mentioned and being able to, streamline customer service or back office functions with new technology. The CPA thing, I saw the same thing. I worked for a CPA firm for 6 months this year, and we got a lot of clients from firms that got bought by bigger firms, because what happened is they'd layer a lot of people and they'd increase the prices and add admin fees and stuff. And the clients were just like, hey, like, I don't want like this army of staff. I just want like one person that can give me an answer. So kind of seeking more simple, pragmatic solutions. And then obviously, when I moved to Austin 4 years ago, it took me like 6 tries to find a dentist. I would go into these private equity backed dentists, and they'd send a finance person out to talk about this like financing plan before they even did the cleaning. So I just think, like, I'm optimistic that there's going to be white space for entrepreneurs, both at big levels and local levels. A friend of mine sent me an article. I guess there's a Nobel laureate that wrote about, like, AI as an example. It's like, a probable but maybe not ideal scenario is that AI will be good enough to replace jobs, but not good enough to deliver excellent experiences. So kind of like what we're seeing, what they talk about with slop, AI slop. So I think some of the things can happen, like, as business gets more impersonal sometimes through these roll-up platforms, that there could be opportunities for entrepreneurship. I guess on that topic, you're in the college environment, on the day-to-day, even when you're a working financial professional, it seems like you still had a connection to the education environment. What are you seeing on the ground floor with inside universities today across AI, career interests, social media? Like, there's so much stuff impacting these institutions.
Again, I'm so excited. We've talked earlier about, I grew up in Washington, D.C. When I was growing up, I didn't know what investment banking was. I went and I had an internship at an investment bank in D.C. that did financial institutions, banking M&A. Even after I did that, I really wasn't sure what we did.
Yeah.
But if you're in, I don't know why I pick mentioning Iowa. I like Iowa, but if you're a kid in Iowa, you have no chance. So think about the matching principle, right? We may have somebody that was great at that, or pick any other profession, but they don't know about it. They don't get information. They can't find out about it. That's over. You can learn anything. We talk about AI. AI is right now an incredible source of information and processing power. It does not have judgment. There is no inference. Everybody says that. It doesn't. They're thinking it's artificial generalized intelligence. It's AI can get you information and can process it very fast. So what does that mean? If you're focusing on a career where you're going to gather information, analyze it, and present it, you're not going to have a long career. That's now a piece of it. If you go to investment bank where you used to have 2 years to learn sort of the process and do the churns, maybe you got 6 months now. And it also means that if I know it, that means anybody else in the country can find out and almost catch me at any point in time. So I wrote something recently, I posted on LinkedIn that it's called living on the edge, that it's not this. This is awesome. It's orange for Texas and stuff, but that's not the edge computer you are. And until we get to AGI, that's going to be the same. So what's amazing is if you have an idea, you can research it, you can find out, you can identify the competitors, you can get really smart about something and give something a try. The fact that the costs have dropped so much, I don't need $5 million to start a software company. I don't know, I might need 50. I mean, think about these companies that raised a lot of money 5 years ago. Maybe they were great companies, but they raised 300 million to build a software stack. And now I can replace that for 5. They've got a bunch of dead capital and I can move faster. It's amazing. And so with AI, to your exact point, AI cannot replace the human element. In investment banking, you're going to have to get your turns faster. It still doesn't replace judgment, human engagement, negotiating, telling the story, being compelling, attracting, retaining, motivating good people. Average company size is going to decline. I'll give you an example. I know all unicorn company valuations are manipulated, but okay. So if you were a unicorn company not focused on AI, the average length of time it took you about 7 years to get there and required 400 employees. If you're AI focused, it's 2 years and about 200 employees. I can give you a list of at least 10 or 12 companies that have that valuation, $1 billion or more, that have 40 employees. We're not going to one. You need a team. You need people around you. But what it does mean is that with a smaller group of people being very nimble, you can build something that's meaningful and get to cash flow profitability pretty quickly. It's going to affect venture capital. What if I just have to raise $20 million and I can get profitable because my costs are so low? I need 10 people and all the things that used to be so expensive, development expense, renting office space, all that stuff goes away or it gets diminished. I may not need to raise another round of capital. Well, anybody that was a VC firm that focused on later round investing, they're going to miss those deals then. The entrepreneurial focus that I'm seeing among students, and look, I'm lucky, fortunate. UT is, one of the top 3 or 4 undergraduate business schools in the world. We're one of the top 20 across all the other measures. We have really good people, but you see it across the country. People that are building their own software, they're trying new entrepreneurial things. In the MBA program, to give your point, we see a lot of people that are MBAs, particularly with military backgrounds, so they understand project management and processes. They're doing what's called entrepreneurship through acquisition or search funds, where they go out and buy an individual company like the ones you're talking about. It's going to be remarkable. And it allows people to go and find out what they enjoy doing, where the opportunities are, and maybe to match themselves. So in terms of the capital that goes to where it's best utilized. And now people get to. We have overinvested and put too many people in consulting, investment banking. You got to build something. Let me give you one quick numerical example to emphasize this. I don't know if you notice, I'm kind of excited about this. Let's say I bought a company. Remember we said that if you bought a company at 8 times and sold it at 12, you're a genius, right? You're buying the house on the Hamptons, maybe even the boat, maybe not a teak deck boat, but you're certainly buying a nice boat. What if you buy at 12 and you're going to sell it?
You're not very smart.
Okay. That's true. And I'm besting a lot of people are doing this. If I buy at 12, and let's say it's 10 times cash flow, I spend 120 million bucks. If I'm going to sell it at 8, now I'm being exaggerated. I sell it at 80. Okay, to hit a 15% return, the only way I can do that is drive cash flow. I have to get cash flow up to $45 million to hit my numbers. It's not that extreme right now, but there are a lot of people who bought at 10 are going to sell at 10 or 9. If the multiple declines on exit, in other words, if I'm selling at a multiple less than what I bought for, more than 100% of my returns have to come from operating improvements. You have to be able to run stuff. You have to be able to build stuff. You have to manage stuff. we're in a renaissance. We're going to focus on building stuff again. It's going to be really exciting.
Yeah, I think a lot about that. I mean, I worked at a family office and we did some stuff in multifamily real estate, and we used to hear all these stories, exactly your point. Like somebody would bring us an off-market deal and we didn't have that good. Like we had a fine reputation, but there are groups that definitely saw it before we did. And, especially in like the Class C space with like, they talk about, adding value. But they're all at the same time, we came across these like syndicate groups with like a leader and a course talking about value added real estate. And for the longest time, you could just buy something, wait 2 years, sell it. Maybe you painted the walls or something, but like, you actually have to have a value added plan. I mean, that's another thing I think a lot about these days is like you have this, base of companies that do real things. And somewhere in the last 30 or 40 years, we've built our services layer and somehow figured out a way to make that services layer, whether it's insurance or finance or bigger legal, bigger than the layer of actual value producing companies, actual building companies. So yeah, I think it's a really exciting time. And it would just be really interesting because it's also incredibly competitive as well.
Here's the thing I think for undergrads and everybody in their careers, if you're thinking about being an entrepreneur right now, look, the whole AI thing, is it a bubble? I don't know. It feels a little frothy. I don't know. I mean, sometimes they got to generate revenues, but there will be some big winners. There are always. They're going to be, a lot of companies get funded. The few that are successful are going to be wildly successful. The others may get acquired, right? If Anthropic struggles, then that's my good friend Claude, of course. You've got, Amazon is a prospective buyer. They're a big investor. OpenAI, I don't know. They're doing some very interesting things. And Johnny Ive's about to release, the designer of all the Apple products is going to release an OpenAI device. Mm-hmm. We'll see what that does, but they're doing interesting things. It is where the internet expanded, very general terms, the internet expanded our sales and marketing opportunities, right? You could tell people all over the world, hey, we've got this thing in Texas. It didn't attack the gross margins that much. And so we always focused on that, assuming that this SG&A layer was kind of consistent across industries. That's over. So the sales part, you still need salespeople. You got to, that whole personal interaction is still there, but HR, marketing, I don't need a design firm. I can ask, again, my good friend Claude, or I want it to be Chet GPT, so it has a nickname. I can call it Chet. Yeah. I can get logos designed. I can get marketing plans. Now, maybe they're not final versions, and if I have proprietary data, then I'm going to get a better result. I have a friend of mine who runs a bankruptcy firm. He told the enterprise version of OpenAI, said, just train on these 4 plans of reorganization that I've done that are great. Gave it a term sheet. It took 72 minutes, produced a 120-page document, call it for $1, that would have taken a senior attorney 4 days and $15,000. Those kind of cost savings are remarkable. To your point, this allows you to start a business. My legal costs are going to drop dramatically to establish the business. And you got to do it right, or else you're going to make mistakes at founding that you're not going to learn until you sell it, and they're going to be very costly. But data analytics, we used to have to hire data scientists or data analysts to just produce reports for us. Now, if I have just an access to my accounting system, I can create PE agents to do it. You don't have to be technical. You just ask it a bunch of questions. This is a remarkable period for this. And so I think the advice would be, if you're going to, it's going to be very difficult to compete against these big companies in AI because they have lots of money. It's a weird thing that the biggest companies move the quickest in terms of AI adoption. Yep. It wasn't the traditional model where a bunch of little ones popped up and then they got acquired. The DOJ was kind of pushing against that, would not approve some of these acquisitions because they didn't want to be concentrated. But that let the big companies like Microsoft and others end up with a very strong position in these markets. They also have proprietary data. I promise you, Netflix has internal technology where they can create new series that's photorealistic. Go look at Tilly Norwood, the AI actress who's already starring in a show. I couldn't tell if she was a person or not. I couldn't tell.
Wow.
So that's all coming. So creativity, your ability to produce things is going to change dramatically. But the human component, the judgment, if you can learn something in your career now, you'll be paid for making good decisions, for providing advice. I met somebody who ran a roofing company, and I asked, how's AI affecting you? He said, well, the place where it's great is an estimation, right? You got to go get the business, you do lead source, you got to do an estimation, then you have to do the work, and then you have to collect. The estimation part is now remarkably accurate and quick. He still has to have people to go out and sell the business and actually do it. All those industries you talked about, dental, throw in physical therapy, they require customer service experiences. You have to be able to work with humans and then use AI to optimize and reduce errors. I think that's the key.
Dr. Ken, you've been so generous with your time today. We've covered a lot. We covered some things that maybe seem like doom and gloom, and also some incredible optimism. What's the best way for people to keep up with you and the work you do? If anybody's interested, I was asked a few weeks ago what hobbies I have, and I thought that I don't have any hobbies. Well, I must lead a pretty slow, dull life. And so I said to my sweet, beautiful wife, Debbie, I said, I think my hobby is I write about AI and macroeconomic stuff and try and make it fun and interesting. And I post those on LinkedIn, and I'm going to start a Substack here when I can figure it out. And so just connect with me on LinkedIn, and I post those every few weeks. Yeah, I mean, you're one of the lucky ones. Kobe Bryant says, if you're lucky, you'll find your passion. And if you're really lucky, you'll find it before you retire. So it's, no hobbies, you just live it. Well, Ken, thanks so much for the time. Look forward to sharing this episode and staying in touch. Adam, it's been great. Really enjoyed speaking with you. Thank you so much. Thank you for listening to Tuesdays with Morrisey. That conversation was with Dr. Ken Wiles, clinical professor of finance and executive director of the Private Equity Center at the McCombs School of Business at UT Austin. What I enjoyed about the episode was talking about the current state of the private equity market and the opportunities for builders in today's environment with AI and other tools and other dynamics. If you enjoyed the episode, share it with a friend, and we'll see you here soon. Thanks.